May I now invite the chief guest for today's function, the Honorable Vice President of India, to address the audience.
Vidyasagar Raoji, the Honorable Chief Minister of Maharashtra, Devendra Fadnavis. It is a pleasure to be here today at this event to mark the 60th year of the Insurance Institute of India. A Diamond Jubilee is a happy occasion for any institution. The longevity points to its continued relevance. It also indicates the maturity and growing collective experience of the Institute. I take this opportunity to congratulate the management, the faculty, and the corporate sponsors of the Institute and wish them the very best in their future endeavors. The Insurance Institute of India, as has already been said by Mr. Roy, formerly the J.C. Setalvad Memorial Federation of Insurance Institutes, was set up in 1955 for the express purpose of promoting insurance education and training in the country. In the last 60 years, the Institute has grown into a professional body serving the cause of the insurance industry by promoting insurance studies, conducting examinations, and undertaking research. The presence of 91 associated institutes spread all over the country, and the affiliation of the Sri Lanka Insurance Institute, the Sri Lanka Insurance Academy, and the RICB Insurance Institute of Bhutan testify to the prestige and professional repute of the institution. Why insurance? Insurance can mitigate the economic impact of events like illness, death, disability, fire, theft, and natural disaster on individuals, households, or enterprises. In doing so, insurance helps people avoid destitution, regularizes their consumption, protects their assets, and allows them to pursue the high return economic activity and make investments. Increasing the access of poor households to insurance mechanisms will prevent them from having to rely on publicly funded support systems. It can encourage them to adopt alternative, more productive livelihoods, for example, planting high yield crops insured against the risk of drought that can help to lift them out of poverty. This would also enable the government to target scarce public resources at the poorest, so that a higher share of poor households is covered by the public social protection system. In this way, insurance is a useful strategy on a continuum of risk management options, ensuring that poor households have access to insurance services should be the priority for us in India. Friends, the insurance industry in India has undergone transformational changes over the last 15 years. Changes in the regulatory environment have encouraged the development of the industry. Liberalization has led to the entry of the largest insurance companies in the world, with India becoming a priority destination amongst the emerging markets. The industry has witnessed rapid growth, intensifying competition, and significant expansion of the customer base. There has also been a number of productive innovations and operational innovations necessitated by increased competition amongst the players. Despite this growth spurt, insurance prevalence remains abysmally low. Insurance penetration or premium volume as a ratio of GDP for the year 2012-13 stood at 3.96%. This was comparable to China, which had insurance penetration of 3%, but below the world average of 6.3%. Insurance density measured as the ratio of premium to population or per capita premium for the years 2012-13 stood at US dollars 53.2 for the insurance sector as a whole, compared to US dollars 178.9 for China. Only about 17% of the population has health insurance in our country, while only about 5.51% of the population is covered under life insurance, according to a report by the insurance regulator, the IRDA. The low penetration of insurance, despite the large population, is a clarion call to deliver insurance at a cost-effective way to the widest section of the society. The provision of insurance for the poor, covering a variety of risks, could well be a key milestone in the fight against poverty. The standard household risks of fire, theft, unemployment, sickness, and mortality are all more severe for poorer families, the marginalized communities, and rural households. In India, a very large number of poor households derive their livelihood from agriculture and face the additional risk of droughts, floods, pests, and diseases affecting their crops and livelihood. People with low incomes are highly vulnerable to financial and health risks, for instance, when there are cases of illness, death, and incapacity to work within the family, or when property is lost. Whole families can be caught in a vicious circle over many generations with little hope of escape. 2/3 of our population, as is well known, is dependent on agriculture. This sector contributes about 17% to the national GDP. Yet, agriculture in our country is highly susceptible to risks like drought, floods, pests, and diseases. In addition, the globalization of economy has created new threats linked to global demands and supply dynamics. It is necessary to protect the farmer from natural vagaries and ensure their credit eligibility for the next season. The high rates of suicides of farmers and the subsequent social and economic impact on the family needs redress. Sustainable agricultural insurance could be a possible step in this direction. Crop insurance presently covers only about 12% of the sown area, and in most cases has an adverse claim to premium ratio. There are problems with both the design and delivery of crop insurance schemes. These problems could be overcome to some extent with rainfall insurance with a well-developed rainfall measurement infrastructure. Private and public insurers are currently experimenting with rainfall insurance products, and the feedback seems encouraging. There is a need to reduce the level of actuarially fair premium rates to make the insurance option attractive and affordable. In parallel, under a long-term and sustainable perspective, we also have to consider risk mitigation through improvements in the irrigation and water management infrastructure. The task is formidable but not impossible. We can look at the successful experience from Africa, where several countries, including Rwanda and Ghana, have undertaken ambitious reforms to expand health insurance to cover a significant share of the national population. In Senegal, Benin, and Mali, the populations are increasingly being covered by mutuelle descente, non-profit, membership-based health insurance organizations with funding based on member premiums. Several African countries have also begun offering weather-indexed insurance to protect farmers at a lower cost than traditional crop insurance and with greater reliability. These models can be modified and adopted by us to expand the coverage of insurance in India. The Government of India has created policies to promote financial inclusion and extend insurance cover to the poor through schemes such as Pradhan Mantri Jan Dhan Yojana, Pradhan Mantri Suraksha Bima Yojana, and the Pradhan Mantri Jeevan Jyoti Bima Yojana. The Finance Minister has indicated that the government plans to cover at least 40% of the population using the plans launched under the 3 social security plans, which includes life insurance, accident cover, and a pension scheme. The schemes come at a nominal premium. The offtake for the schemes has been encouraging, but beyond the government action, the current industry structures and economic models are not yet conducive to its large-scale success. The main challenge is to encourage poor households to invest in insurance as one of a menu of social protection investments. Microinsurance for life, agriculture, and health coverage of the economically disadvantaged sections is a possible alternative, but its prevalence in our country remains low and will remain so until the insurers go beyond the traditional distribution models. For microinsurance to succeed, demand has to be generated through building awareness, rationalizing the subscription costs to income levels, and creating specific and simple products, and above all, by simplifying the processes of underwriting and claim management. Ladies and gentlemen, the lack of equitable participation in the India growth story is of concern to the government and financial sector regulators. However, financial inclusion, including in the insurance sector, is an expensive proposition. For financial inclusion to succeed, it must evolve from being a social or regulatory obligation into a viable business proposition. The need is to employ emerging technologies, generate awareness by increased financial education of masses, and move beyond the traditional products to shift from a cost-centric model to a win-win revenue-generating model that provides quality financial services on a sustainable basis to the economically disadvantaged. I am certain that the Insurance Institute of India will continue to play an important role in this endeavor. Jai Hind. The history of the Calcutta Chamber of Commerce approximates the history of modern commerce in India. Starting as the Calcutta Traders Association in 1830, the Chamber has indeed come a long way from trading opium chests headed to China. The Chamber, which is amongst the oldest of its kind, not only in India but the whole of Asia, has seen tumultuous changes, from colonial commerce under British rule to the industrialization of an independent India to the information revolution. The Chamber has championed the cause of the local business and has worked to further growth of commerce in Bengal and Eastern India. In addition to promoting commercial interests of its members, the Chamber has also taken a keen interest in improving the civic amenities and infrastructure in the city. It has played an important role in shaping the rise of Calcutta, now Kolkata, as a modern metropolis. I am informed that the Chamber has a catalytic role in the development of the Calcutta-Burdwan railway line and of the iconic Howrah Bridge. 5 years ago, India's export story looked strong and convincing. Merchandise exports grew at a healthy annual average growth rate of 22% in the 5 years preceding the crisis. After a small blip in 2010, exports smartly recovered and grew at 30% in the next 2 years post the crisis. However, since 2013, India's export growth has stalled. Export growth rates fell to about 1.2% in 2013 and 2014, and this trend has continued in 2015 with the export growth at an average rate of 2.2% per year to date. This fall in export growth is disturbing. In the last 2 decades, India's export has diversified both in terms of markets and products. Our export sector has also moved up the value chain. The share of traditional exports like primary products, textiles, ready-made garments, leather products, and agricultural commodities has nearly halved from 56.5% in 1992 to 27.3% in 2014. Petroleum products, engineering goods, transport equipment, and electronic goods together now account for over 40% of exports as compared to 14% in 1992. Our exports have also found new markets. The size of developed countries in India's exports has declined, and that of emerging economies has increased. Asia and Africa together now account for 60% of our total exports, up from 37% 2 decades ago. What is worth noting is that exports to Africa have grown exponentially, and the region's share in total exports now stands at 10%. Product and geographic diversification has helped India's exports so far. But for exports to grow further, manufacturing, which accounts for 60% of the export basket, will have to become more competitive. UNIDO's competitiveness of industrial production, or CIP, is a composite index that measures the ability of countries to produce and export manufactured goods competitively, with 1.0 being the best score. It is based indicators grouped along 3 dimensions of industrial competitiveness: capacity to produce and export manufactured goods, technology deepening and upgrading, and world impact. While India's CIP score has improved from 0.04 in 2000 to 0.07 in 2010, one needs to compare this with China, whose CIP score improved from 0.16 in 2000 to 0.33 in 2010. Similarly, while India has managed to increase its share in world manufacturing value added from 1.1% in 2000 to 2% in 2010, China more than doubled its share from 6.7% to 15% over the same period. The relative lack of technology inputs in Indian manufacturing can also be gauged by the share of medium and high-tech activities in manufacturing exports in India. It did improve from a dismal 18.7% in the year 2000 to 28.2% in 2010, in contrast to that of China, which was 60.2% in 2010. Even in terms of productivity and efficiency, we need to improve. According to the Asian Productivity Organization Productivity Database for the year 2014, average total factor productivity growth in India rose from 2% in 2000 to 2005 to 4.7% during the next 5 years, 2005 to 2010, but fell to 0.9% in the following 2 years. However, for China, the average total factor productivity growth was 3.9% during 2000 to 2005, rising to 4.2% during 2005 to 2010, and falling to 2.1% over the next 2 years. During the period 2010-2012, while the total factor productivity contributed 11% to our GDP growth, its share in China's GDP growth was 26%. To get back on a higher export growth trajectory, we in India would need to improve manufacturing competitiveness, and this point needs to be reiterated again and again. According to UNCTAD's last report on global trade, and I quote, India's exports to the world are much more responsive to income changes as compared to price changes, end of quote. UNCTAD has estimated that a 1% decline in global GDP growth, 0.88% decline in India's growth of exports, while a 10% reduction in prices will lead to only 5.4% increase in exports. While this implies that exports have remained weak in the past 2 years owing to weak growth in our export market, it also means that increasing exports will require much higher price competitiveness than ever before, especially if global growth remains muted. Our export performance is crucially linked to the performance of its domestic manufacturing sector. India has the potential to manufacture and export a wide variety of goods, from the world's cheapest indigenous cars to Mangalayam. India has proved its mettle time and again. Still, India's share in global exports is a mere 1.7%, and manufacturing output as a percentage of GDP is around 13%, much lower than its Asian competitors. The Make in India campaign launched by the government has the vision and the faith in India's ability to achieve the goal of becoming a manufacturing export hub. However, this is just the beginning, and more concrete steps need to be taken to achieve the desired objective. Emphasis on the manufacturing sector, especially small and medium enterprises, will be critical to our export growth. Ladies and gentlemen, the city of Calcutta, now Kolkata, servicing the rich hinterland of Bengal, was an important commercial hub all through the 18th and 19th centuries. Today, West Bengal, with a higher than average GDP, stands ready to claim its rightful place in a rapidly growing India. The state is fast becoming an attractive destination for investors, and doing business in Bengal today is easier, simpler, and faster. Looking ahead, I believe that the local chambers of commerce have an important role to play in fostering innovation and competitiveness of Indian manufacturers. The chamber can act as a conduit for business to government interface, as also the nodal point to increasing the interaction between businesses and research institutions to help transmit innovations and new technologies into the industries. The future success of a Chamber of Commerce will be determined by its strategic development into a dynamic center of community influence, focusing not just on traditional business issues, but on overall financial health and well-being of the community. In addition to its advocacy role, a progressive Chamber of Commerce will need to increase the size and scope of its membership umbrella by soliciting a more diverse membership and partnership arrangements, from universities to think tanks, in order to better energize the economic pulse of its community and foster innovation. I am certain that the Calcutta Chamber of Commerce will leverage its vast experience and history to successfully play this part. I thank you for inviting me today. Jai.